Greenhaus joins me from BTIG, one of the biggest trading firms on the street. Let me ask you about the volatility we've seen today. It's back, although not in as violent a way, and we're not lower, so it doesn't feel as bad. But why?
I think something that we've been talking to our clients about, something that Wes Cardone, who runs our options desk, has been talking about with clients, is just the reality of the current situation, which necessitates a higher level of volatility. And while certainly we've been trending higher over the last couple of days, the 1100 low has been put in for now, and we're pushing higher. You haven't seen a commensurate decline in the VIX, which is now, of course, at about 32 or so. We think that's here to stay, and it traditionally takes many months for volatility to quote-unquote normalize.
Lisa points out we're now looking at least marginally positive on the Dow year to date. Does that make sense to you? Is that where we should be?
Well, coming into the year, I was more, I'll say, less optimistic than a lot of other people on the street. Certainly, the recent decline is complicated.
More subdued or outright bearish?
I wouldn't say it was outright bearish. I was looking for a more moderate gain on the order of somewhere around 8%. That stood in stark contrast to the 15+% gains that some other people have been requesting. But generally speaking, I think that, to the extent that the market can push higher here, investors can realize some returns. But the fact remains, in a secular sense, the market's gone nowhere for 10 years, and we're pretty sure that's going to continue for the next 3 to 5 years.
It feels like a lot of people got out of this market. It felt like that already until the incredible volatility, and then it felt like the rest of the baby boomers left. Do you think that's one of the problems?
Well, I think something that is an underappreciated story is the fact that baby boomers never came back after the NASDAQ bubble burst. Equities as a percentage of household assets, which is sort of a proxy for exactly what we're talking about, has not even come close to, quote-unquote, rebounding in a sustained and sufficient manner. I think this is increasingly a market that's not reliant on baby boomers. That's not to say that they have...
Unless they're running computer trading networks.
Unless they are running algos, sure. I mean, that's not to say that they've left entirely, and that's not to say that 0% of your retirement portfolio should be allocated or is allocated to equities. But as a general rule, we've had two terrible bear markets. In 10 years, you have the flash crash, you have the recent decline. There's a level of fed-upness, if I can invent a word and a phrase here,
I like that phrase.
Among the 50-plus set with respect to equities as a generalized risk asset class.
Hang on.
And I'm curious where you are on Treasuries right now, what you think is going to be going on for the remainder of the year.
Well, good to see you, first of all. And second of all, within the context of BTIG's outlook in a secular sense, we think that, and what you've seen is investors, depending on your risk preferences, should certainly have a larger allocation to fixed income products. That doesn't necessarily exclusively mean treasuries, but fixed income products in generally. At the same time, if the question is, would I be initiating brand new positions at yields closer to 2% than 2.5%, the answer is no. I think, the level of depreciation that could occur in your bond portfolio is fairly insufficient to compensate you for, the level of interest that you'd be receiving is insufficient to compensate you for an even modest decline in the value of your bond portfolio.
Where do you go for yield then? I mean, if you don't have $5 billion to park at Bank America, right, for $300 million a year, what do you do to get a little bit of yield here?
Well, the obvious answer is certainly high-yielding, dividend-paying global international equities. But certainly, BTIG...
Not if you have a very pessimistic outlook, though, for the global economy, right?
To the extent that again, it depends on who we're talking about. If you're an institutional investor that has to be invested, then high-yielding global international equities are a great place to start. Historically, roughly 50% of your return is generated by dividends, not by capital appreciation. So there's, from an academic standpoint, an increasingly solid reason on which you want to be exposed to those equities. But at the same time, there are corporate bonds which have been decimated in the recent decline, and particularly high-yielding bonds. Our high-yield desk over at BTIG has seen increased inquiries, at least, by clients. Where can I go to pick up a little extra yield? So you said, on the event or in the event that equities don't necessarily return what I've become accustomed to.
And I want to bring Dan in as well, because he mentioned he was talking to his options team before the interview today. Jeff Kearns, our options strategist here at Bloomberg, crunching some numbers. U.S. open interest is now at a record, suggesting traders are using options probably the most they've ever done in the history of Wall Street. Dan, what does that suggest for the S&P 500? Is it going to break us out of the rut, or does it mean more uncertainty for the months to come?
Well, I don't know that it necessarily means anything per se. I think certainly there's an argument to be made that equities can drift higher here, both primarily on a valuation standpoint, although I don't necessarily buy that on a larger term framework. But I think, to the previous point that was brought up about QE3, there's certainly a point brought up by several market participants that QE3 is out there in the market. I entirely and forcefully disagree. I think, certainly the Fed has opened that door. Ben Bernanke in his speech sort of alluded to the range of tools. In the Fed minutes today, they discussed a range of tools. But I am absolutely, at this moment in time, not in the QE3 will be launched in September camp, and I don't think anything other than my personal opinion would suggest otherwise. Just saying it doesn't make it so.
Got it. Dan, thanks so much. Great to get some time with you again here. Dan Greenhaus, Chief Global Strategist at BTIG.